Welcome to this segment of GTM Training Shorts, presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we'll address the question, what are the tax consequences of a restricted stock award or restricted stock units? Listen in to Michael Bowman, Director and Ohio Regional Office Lead, as he explains.
So what are restricted stock awards and restricted stock units? An RSA represents a situation where shares in the company are granted to an employee and in their name, but which are not fully transferred until certain conditions are met. The satisfaction of these conditions is referred to as vesting. Examples of certain vesting conditions might include service, meaning the passage of time, market conditions, the achievement of certain share price or relationship to a particular stock index, or perhaps performance, reaching certain financial targets, benchmarks, or milestones. Vesting may also have certain triggers. For example, many plans have clauses which trigger vesting under certain conditions, such as change of control. In addition, awards made to retirement-age employees are considered vested at retirement age, regardless of award terms or vesting requirements. Moreover, if there are certain performance conditions that are not expected to be enforced, then vesting may also be triggered. An RSU represents a scenario in which the rights to shares or equivalent value in money is awarded to an employee upon satisfaction of the vesting conditions. From a classification perspective, RSAs are considered property, whereas RSUs are not. This distinction is important from a planning perspective, as certain elections are only applicable to interest in property, namely Section 83B. Also, since there is an option to receive either shares or equivalent in money's worth in the case of RSUs, these awards are classified as liability type and are required to be marked to market each reporting period. We're going to walk through some nomenclature now that's important to share-based compensation generally. The grant date is the date the award is granted to an employee, whereas the vesting date is the date when there are no longer any restrictions to an employee's ownership of the stock, also commonly described as the date when there is no longer a substantial risk of forfeiture, which in turn refers to the risk that a particular benefit might not be conferred to an employee due to failure to achieve certain conditions of an award, such as the service period, performance, or market conditions. The exercise or strike price is the price that an employee must pay to exercise the option to purchase the stock under stock option award plan. And lastly, the date on which the stock is sold or otherwise transferred to an employee is referred to as the disposal date. Tax consequences of restricted stock can best be summarized by an example. For this example, assume the following. The employee is awarded 100 shares of stock with an aggregate fair market value on the date of grant of $500 or $5 a share. The shares will vest in year 4 when the aggregate fair market value of the stock is $2,000 or $20 a share. Further, the employee will sell the shares in year 6 for a total of $3,000 or $30 a share. Section 83 of the IRC governs the treatment of property received in exchange for services. The basic operation of the rule is that there is no recognition of income until there is no substantial risk of forfeiture in the property awarded, i.e. until vesting occurs. There's no taxable income on the date of grant because the stock is not vested, i.e. there is substantial risk of forfeiture. Vesting of stock awards does mark a taxable event because the employee now owns this property free and clear. And lastly, there's the stock sale that impacts the employee only as it is a private transaction at that point. So looking at the box at the bottom of the slide, on the grant date, again, there's no income to the employee, therefore the employer does not take a deduction. On the vesting date, when that risk is removed, the employee or recipient recognizes $2,000 of ordinary income, which is the fair market value of the stock, allowing the employer to take the corresponding $2,000 deduction. And lastly, in year 6, When the stock is sold, the employee recognizes a gain, which is the difference between $3,000 and $2,000 or $1,000 and his long-term capital gain. And at that point, it's a private transaction, so there's no impact to the employer.
For more information on the tax consequences of share-based compensation awards, check out our Corporate Income Tax Compliance Fundamentals 2 program. Scan the QR code or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.